$1.7 trillion gone in 90 minutes. I want you to really think about that number for a second. 1.7 trillion is more than the entire GDP of Spain, more than the GDP of Mexico. And it just vanished from the precious metals market in less time than it takes to watch a movie. This morning, gold was trading at $5,100. Silver hit an all-time high of $117.75. 90 minutes later, gold crashed to $5,000. Silver collapsed to $103. Gold dropped 2%. Silver dropped 12%. And if you're watching this wondering what just happened and whether you should be panicking right now, I need you to stay until the end of this video, because what I am about to show you completely changed how I see this crash. I'm going to pull up a 30-year chart that explains exactly why this crash happened and why it was actually predictable if you knew where to look. And I am going to show you what happened the last time silver touched this exact same price level. Spoiler, it went up 462% after that. But first, let me show you what actually caused $1.7 trillion to evaporate in 90 minutes. Welcome to the hidden economy. I break down the financial moves that mainstream media misses. Hit like and subscribe button if this video helps you understand what just happened. And let us get into it. So here is what happened this morning that sent shockwaves through every trading floor on the planet. At approximately 9 a.m. Eastern Time, silver was trading at $117.75 per ounce. This was a brand new all-time high, the highest price silver has ever traded in recorded history. Gold was at $5,100, also near record highs. Everything looked bullish. Everyone was celebrating. Then, within 90 minutes, silver crashed from $117 to $103, a $14 drop, 12% of its value gone in less than 2 hours. Gold dropped from $5,100 to around $5,000, a $100 drop, about 2%. Now here is where it gets interesting. Gold dropped 2%, silver dropped 12%, same market, same time frame. Completely different reactions. Why? That question is the key to understanding everything I'm about to tell you. Before I explain what caused this crash, I need to teach you something that will completely change how you look at price charts. And I promise to make this so simple that even if you have never looked at a chart in your life, you will understand it by the end of this section. When traders look at charts, they look for two things: support and resistance. Think of it like this. Imagine you are bouncing a ball in a room. The floor is support. Every time the ball hits the floor, it bounces back up. The ceiling is resistance. Every time the ball hits the ceiling, it bounces back down. In markets, support is a price level where buyers show up. Every time the price drops to that level, people say, "That is cheap. I want to buy." And the buying pressure pushes the price back up. Resistance is the opposite. It is a price level where sellers show up. Every time the price rises to that level, people say, "That is expensive. I want to sell." And the selling pressure pushes the price back down. I'm going to show you a 30-year chart now that made my jaw drop when I connected the dots. From 1996 to 2014, silver traded inside what we call a descending channel. Picture two diagonal lines going down from left to right, with the price bouncing between them like a ball bouncing between two walls. During this entire 18-year period, there was one line in the middle of this channel that acted as a key level. We will call it the white line. In 2008, during the financial crisis, silver dropped all the way down and touched this white line. At that moment, silver was trading at $8 per ounce. $8. Now pay attention to what happened next. After touching that white line in 2008, silver did not just bounce. It went absolutely parabolic. From $8 in 2008, silver ran all the way to $45 in 2011. That is a 462% gain in about 2.5 years. The white line was support. The ball hit the floor and bounced up hard. Now fast forward to today. From 2014 to 2026, silver has been trading in a new upward channel. Picture two diagonal lines going up P from left to right. And guess what just happened? Silver touched that same white line again, the exact same level that acted as support back in 2008. But here is the critical difference. In 2008, silver was coming down and hit the line from above. The line acted as support, the floor. In 2026, silver was coming up and hit the line from below. The line is now acting as resistance, the ceiling. The floor became the ceiling. And what happens when a ball hits a ceiling at high speed? It bounces back down. Hard. That is exactly what happened this morning. Silver hit a 30-year trend line that has defined major turning points in the market for 3 decades. The rejection was violent because the level is significant. This was not random. This was not manipulation. This was not a black swan event. This was a textbook technical reaction to a major multi-decade resistance level. And this is why gold only dropped 2%, while silver dropped 12%. Gold did not hit any major historical resistance level this morning. It just got caught in the general precious metals sell-off. But silver hit the line that matters, the line that has defined this market for 30 years. Now you might be thinking, okay, so silver hit resistance and dropped. Does that mean the bull market is over? Should I sell everything? Not so fast. Let me tell you what happened after silver touched that white line in 2008. Remember, silver was at $8 when it touched the line in 2008. Over the next 2.5 years, it went to $45, a 462% gain. But here's what most people forget. Silver did not go straight from 8 to 45 in a smooth line. There were crashes along the way, violent ones, 30% drops, 40% drops, shakeouts that made people think the bull market was over, but the overall trend was UP. And you know what else. In 2011, silver eventually broke through that white line resistance and went even higher. So here's the key question. Is this crash the end of the silver bull market, or is this just a normal correction within a larger uptrend? A shakeout before the next leg higher? Let me show you the evidence on both sides, and then you can decide for yourself. Now I need to explain the second reason silver crashed 12%, while gold only dropped 2%, because this part is crucial. The CME Group, which runs the COMEX exchange, where most gold and silver futures trade, just did something that has historically marked major turning points in the precious metals market. They raised margin requirements. Let me explain what that means in the simplest possible terms. When you trade futures, you do not have to put up the full value of what you're buying. You put up a small percentage called margin as collateral. It is like a down payment. If silver is trading at $100 per ounce and a futures contract is for 5,000 ounces, that contract controls $500,000 worth of silver, but you do not need $500,000 to trade it. You might only need $20,000 in margin. That $20,000 controls $500,000. That is called leverage. Now here is what happens when the exchange raises margin requirements. Suddenly, that same trade requires $25,000 instead of $20,000, or $30,000, or $32,500, which is exactly what CME did last week. They raised silver margins by 47%, from around $22,000 to $32,500 per contract. If you are a trader who is fully leveraged, you now have a problem. You need to either add more cash to your account immediately, or you have to close some of your positions. Most traders cannot add cash on short notice, so they are forced to sell. And when thousands of traders are forced to sell at the same time, what happens to the price? It crashes. This is called a liquidation cascade. Forced selling triggers, more forced selling as prices drop, and more margin calls get triggered. The CME margin hike was the mechanical trigger. For today is crash. The 30-year resistance line was the technical trigger. Put them together and you get a 12% crash in 90 minutes. Now here's the part that should make you very nervous if you are short silver, or very excited if you are looking to buy the dip. This is the exact same playbook that has been used at every major silver top in modern history. In 1982, brothers named Nelson and William Hunt had accumulated massive silver positions. Silver went from $6 to $50 in about a year. Then the COMEX implemented something called Silver Rule 7, which put heavy restrictions on margin buying. Silver crashed from $50 to $10 in a matter of weeks. The Hunt brothers went bankrupt. In 2011, silver ran from $8 to nearly $50. Then the CME raised margin requirements 5 times in 9 days. Silver crashed from 50 to below 30 in weeks. And now in 2026, silver ran from around $30 to $117. CME raised margins by 47%. Silver crashed 12% in 90 minutes. Same playbook, different decade. The question is, what happens next? Because here's the thing that nobody is talking about. After the 1980 crash, silver entered a 20-year bear market. That crash was the end. But after the 2011 crash, silver dropped from 50 to below 15 over the following years. However, the bull market eventually resumed and silver is now trading at over $100. So the 2011 crash was not the end. It was a correction within a larger secular bull market. Which type of crash is this one? Let me give you the evidence, and you can make your own decision. First, the bearish case. The reasons this crash might be the beginning of something worse. Silver has gone up 270% in 12 months. That is an insane move by any standard. Parabolic moves like this often end badly. The gold to silver ratio has compressed dramatically. When this ratio gets stretched too far, it often snaps back violently. Speculative positioning is at extreme levels. Everyone is on the same side of the trade. That is usually when the trade reverses. Margin hikes historically mark tops. 1980, 2011, now 2026, now the bullish case. The reasons this crash might be a buying opportunity. The fundamental supply and demand picture has not changed at all. China still restricted silver exports on January 1st. That is still in effect. That still affects 60 to 70% of global silver supply. COMEX inventory is still down 70% from its peak. The registered silver available for delivery has collapsed from 86 million ounces to 28 million ounces. That has not changed. Industrial demand is still exploding. Solar panels need 200 million ounces per year and growing. Electric vehicles need silver. AI data centers need silver. 5G infrastructure needs silver. None of that changed this morning. The structural supply deficit is still the worst in history. 5 consecutive years of demand exceeding supply. 820 million ounce cumulative shortage. None of that changed. Physical silver in Shanghai is still trading at a $6 to $9 premium over the paper price. If the bull market was truly over, that premium would collapse. It has not. And here is the most important point. In 2008, when silver touched that white line at $8, the fundamentals were not this strong. There was no China export ban. There was no solar panel boom. There was no EV revolution. There was no AI infrastructure build out. The fundamentals today are arguably the strongest they have ever been in silver market history. Yet the technical setup triggered a crash. This is the tension you need to understand. Technical factors can cause short-term crashes even when fundamentals are screaming bullish. The question is whether the technicals will ultimately bow to the fundamentals or whether the fundamentals will bow to the technicals. Historically, fundamentals win over the long term, but technicals can create tremendous pain in the short term. Now let me tell you something that happened in the physical market today that almost nobody is reporting. While the paper price crashed 12%, guess what happened to physical silver premiums? They actually increased. Dealers were not lowering their prices by 12%. They were barely lowering them at all. Some actually raised premiums because demand spiked as bargain hunters tried to buy the dip. This is the same dynamic we saw in the nickel market in 2022. The paper